Ever feel like you're on a roller coaster just watching Bitcoin's price? You're definitely not alone. It's the Wild West out there. But what if you could see past the hype and understand the forces actually driving those crazy swings? That's what this deep dive is all about. We're going deep into some serious research, a 2022 paper called What Drives Volatility in Bitcoin Market. Now, don't worry, we've done the heavy lifting, sifting through the technical stuff to bring you the most fascinating insights. And believe me, there are some real surprises.
What's fascinating about this study is that it uses a really robust statistical approach. It's called dynamic Bayesian model averaging. It's particularly useful here because it allows researchers to test a whole bunch of potential factors, 22 to be exact, and see which ones consistently have the biggest impact. It's like using a sieve to separate the most important factors from the noise.
Okay, so no more beating around the bush. This study uncovered four main things that really move the needle on Bitcoin's volatility. And buckle up, because some of these are real head scratchers.
One of the most intriguing findings is the power of, simply people talking about Bitcoin. The study actually used Google Trends data. How many people are searching for Bitcoin as a measure of public attention? Turns out, when searches spike, prices tend to get more volatile.
So it's like a self-fulfilling prophecy. Everyone's talking about it. Suddenly everyone wants in on the action. Prices go haywire. Classic FOMO, am I right? Ever gotten swept up in something like that?
Perhaps a time or two.
Right. Happens to the best of us. But in the world of Bitcoin, that impulse buying can have a ripple effect, turning those price swings into tsunamis.
What happens is you've got a wave of new investors who might not be familiar with the ins and outs of the market. Their decisions are driven more by emotion than careful strategy. And that can lead to some pretty drastic moves.
Okay, that makes total sense. More buzz equals more volatility. But get this, the next factor is kind of the opposite of what you'd expect. As more Bitcoins enter circulation, the price actually tends to stabilize. It seems counterintuitive, right?
It does seem counterintuitive on the surface. However, this finding actually aligns with basic economic principles of supply and demand.
All right, walk us through it.
So remember, there's a cap on Bitcoin. Only 21 million will ever exist. As more are mined and enter the market, the supply naturally grows. Now, if demand stays the same or grows slower than the supply, Economics 101 tells us that prices should go down, leading to less volatility.
It's like the old saying, too much of a good thing.
Right.
The more you have of something, the less valuable it becomes.
Exactly. It's the basic principle of scarcity at play.
Yeah.
But what's really interesting is that the study also uncovered a link between Bitcoin volatility and something you might not expect: how optimistic people in the U.S. are feeling about the economy overall.
Okay, now that is fascinating. So we're talking about consumer confidence. What's the connection there?
Right. Consumer confidence. The study found that when U.S. consumers are feeling good about the economy, Bitcoin actually becomes less volatile. And conversely, when consumer confidence dips, Bitcoin's price tends to swing more dramatically.
Almost like Bitcoin is seen as a riskier bet when the traditional economy is strong. Like, if people are feeling secure in their finances, they're less likely to jump into the crypto ring.
That's a really interesting way to think about it. And it taps into a crucial point: investor psychology. When the economy is humming along and people are confident, they might stick to more traditional, stable investments. But throw in some economic uncertainty, and suddenly Bitcoin might start looking like a potential safe haven, a hedge against a shaky system.
I see. So it's like looking for an alternative route when the main road gets a little bumpy.
Exactly. And this ties into a much larger conversation about Bitcoin's role in the global market. Is it just a speculative asset? Or is it becoming something more established, more intertwined with the traditional financial systems?
Which brings us to the final piece of the puzzle, right? The study also looked at how Bitcoin's volatility is affected by the S&P 500, that big stock market index. What did they find there?
This is where it gets particularly interesting. They discovered that when the S&P 500 goes up, Bitcoin's volatility actually tends to go down. And this correlation became even more pronounced in the later years they analyzed.
So are we talking about a bit of a delayed reaction then?
It seems that way. You see, in Bitcoin's early days, its price movements were often seen as completely separate from traditional markets. But as it's matured and become more integrated into the global financial system, it seems to be increasingly influenced by how traditional assets are performing, as reflected in the S&P 500.
If Bitcoin is becoming more closely correlated with the traditional market, what does that actually mean for someone who's thinking about investing in crypto?
That's the million-dollar question, isn't it? On the one hand, this connection to the S&P 500 could mean less volatility for Bitcoin. which some investors might see as a good thing, especially those who found the wild swings a bit daunting.
Yeah, it's like Bitcoin is finally growing up and acting a bit more predictable. But there's got to be another side to this coin, right?
Exactly. The potential downside is that Bitcoin might become less appealing as a way to diversify an investment portfolio. You see, one of the original attractions of Bitcoin was its independence from traditional markets. It was seen as an uncorrelated asset class, meaning its price moved independently of things like stocks and bonds. If it starts behaving more like a regular stock, it loses that unique edge.
So it's a trade-off. More stability might mean less risk, but it could also mean fewer opportunities for those massive gains that early Bitcoin investors saw.
Precisely. It's a classic dilemma for investors. Do you chase the high-risk, high-reward potential of more volatile asset? Or do you opt for the relative stability of something more established? The answer, as always, is it depends. It depends on your individual risk tolerance, your investment goals, and your understanding of how these markets work.
Couldn't have said it better myself. So to bring it all back, what are the key takeaways from our deep dive into Bitcoin's volatility?
We've learned that while Bitcoin's price might seem to bounce around randomly, there are actually identifiable factors at play, things like media hype and investor psychology, the basic economic principles of supply and demand, even global events and the performance of traditional markets.
Absolutely. We've got the everyone's talking about it effect, the stabilizing influence of a growing Bitcoin supply, that surprising connection to how confident US consumers are feeling, and the increasing correlation with the S&P 500.
And the key thing to remember is that Bitcoin is still young, still evolving. Our understanding of it has to evolve too.
It's like trying to hit a moving target, right? So here's a final thought for you to ponder as you navigate the world of Bitcoin and beyond. If Bitcoin keeps moving closer to traditional markets, will it eventually lose that rebellious streak that made it so appealing in the first place? Or will it find a way to carve out its own unique space in the global financial landscape?
It's a question worth considering.
It definitely is. And on that note, we'll leave you to mull it over. Until next time, keep exploring, keep learning, and never underestimate the power of knowledge.